morning, everyone, and welcome. Thank you for joining us for this virtual event. Without further ado, it is my pleasure to introduce Alfonso Peccatelli, the founder and CEO of Macro Compass, a disruptive investment strategy firm whose mission is to democratize professional macro analysis tools and portfolio strategy. And to our live viewers, please type any questions that you may have for Alfonso in the chat box. Time permitting, I will announce those questions at the end of his presentation. And with that said, Alfonso, I'll be right here if you need anything, and the floor is all yours.
Thank you very much, and welcome, guys. This is Alf speaking. Alfonso is my full name. Without further ado, I am going to share the screen with you guys, and I am going to walk you through my presentation, assuming I actually find the right presentation, as I have too many open, but I'm pretty sure that I will get there soon. Yes. Yeah, that's correct. So the thesis of this presentation is to tell you that, and to show as well from a data-driven perspective, that the models of the Macro Compass, which is the macro firm I run, are pointing to a recession in the US starting around May, June 2023. It's easy to say there is going to be a recession. The hard part is to time it right, and also to understand which magnitude this recession is going to have. We follow a data-driven approach. And of course, we have a base case outcome, and we work with probabilistic assumptions. But this base case outcome at the moment is a recession starting around May this year. Let's see why. I'm going to use 5 different forward-looking indicators that we track and show you why do we think a recession starts in May. Let's first define what a recession is. A recession gets classified exposed with 2 negative quarters of GDP growth consecutive. In reality, as we look live at a recession, what's happening today, without waiting for the NBER to classify.
Alfonso,
Yes.
I'm sorry to interrupt. It doesn't look like your screen is sharing properly.
Oh. All right.
We'll just put you on pause for a second, see if we can get that fixed.
Yeah. Okay. Is it sharing now? Is it visible? Shelley, if you're still there, is my screen sharing now? Hello, is the screen sharing? Well, I'm going to assume that it is. And if it's not,
it's fixed. I'm sorry. You're good to go.
All right, good. So as I was saying, I'm going to use 5 different indicators, 5 different forward-looking macro indicators that show that the recession starts in May. What is a recession as we look at it live is earnings dropping, so negative earnings growth, and the job market recording losses, so unemployment going up. This is what classifies a recession as we experience it. Later on, it also reflects in 2 quarters of negative GDP growth as classified by the NBER. The first forward-looking indicator I'm going to show you is my flagship global credit impulse. That's the orange line. Now, what I do there is I aggregate the credit creation of the 5 largest economies in the world. I look at it in real terms. So it's inflation-adjusted real economy money printing. It's the creation of new money that we as the private sector can use to stimulate economic growth. And it's aggregated looking at the 5 largest economies in the world in real terms. Now, when this orange line goes up, it means there is a lot of real economy money printing happening all at once. Consumers and corporates are getting inundated with money they can spend in the real economy to boost inflation and to boost growth. As you can see, the blue line here is the S&P 500 earnings growth. And it acts basically with a lag against the credit impulse. So if the credit impulse goes up very rapidly, 9 months later, generally earnings per share growth will be also very aggressive. That's what we have seen in 2021. So in 2020, there was a lot of real economy money printing, checks sent at home to American people, for example, and 9 months later, earnings per share went up by 50% on a year-on-year basis. Now look at where we are today. we are looking at one of the fastest deceleration in real economy money printing over the last 7 years for sure. If I would prolong this time series, it would be one of the fastest over the last 20 years in terms of decelerations. This rapid deceleration leads earnings per share growth with 9 months, with a 9 months lag. That means that as this deceleration happened throughout 2022, earnings in 2023 are supposed to follow the blue line down, which, looking at the right end of the scale, means earnings per share should roughly decline by 10 to 20% between 2023 and 2024. When year-on-year earnings per share growth turns negative, generally that marks the beginning of a recession, especially if the labor market is weakening as well. The orange line here shows that negative year-on-year earnings per share are expected by March, April this year. So one can argue that around May, June, we are going to be ticking this box of negative earnings per share growth, which marks the start of a recession, and obviously earnings are going to weaken materially after that. My expectation is earnings to drop 10 to 20% in 2023. Now, of course, a recession doesn't make a recession per se. It needs the broad macroeconomic indicators to drop consistent with recessionary conditions. The conference board develops this top 10 leading indicator index that you see now in the chart in orange. And there is a particular trigger that over the last 50 years has predicted a recession with a 100% hit rate. That's when this series prints negative on a year-on-year basis for 2 or more consecutive months. It worked in 1974, in 1980, 1990, 2001, the great financial crisis, the COVID crisis, and now this is where it's pointing to. The trigger of 2 or more negative year-on-year prints in this leading indicator index was hit in August 2022. The average lead time over the last 50 years between this trigger being hit and a recession to start is 7 to 8 months. So that again points to roughly April, May 2023 as the start of a recession. How bad is a recession going to be? Well, so far the indications is it's going to be at least in line with the 2001 recession. And just as a reminder, in 2001, the Federal Reserve cut rates by 475 basis points. Earnings declined by 40% from peak to trough all the way into 2002. And if you look as well at the magnitude of a recession predicted by the credit impulse as well, you have earnings dropping in the 20% area. So you're talking about a recession so far, looking at these 4 leading indicators, starting in roughly May 2023 and being relatively severe. But again, we can't base our assessment on only 2 leading indicators. Let's look at the third one. Third one is really economic activity. This is the Philly Fed New Orders Index. So it's a subcomponent of the Philly Fed survey, which is a very relevant survey because it gets sent out to 125 CEOs taking relevant decisions when it comes to economic activity, hiring, and so on and so forth, and especially being on top of what is the flow of new business coming in for their companies. Also here, when the 12-month moving average of this new order subcomponent lows below 15 for 2 or more months, you are certain to have a recession. That trigger was it in September 2022. The series continues to point to the downside. And also here, as you can see, the average lead time is 8 months, recession to start in May 2023 again. And when it comes to the severity of the recession, again, we're looking at something that is relatively strong. We're looking at levels at least in line with the 2001 recession. When you look at broad economic activity, you can't ignore the labor market, because at the moment, what's holding on still relatively well in the US is the labor market. We are seeing manufacturing activity declining pretty rapidly, services activity now also declining. But we are seeing a labor market which remains still relatively strong. The issue with the labor market is it's a lagging indicator. It takes a while until the leading indicators play into the labor market, but we are about to get there. Look at this chart. In orange, you can see US financial conditions. And in blue, you can see the year-on-year growth of non-farm payrolls 9 months later. So the financial conditions in orange effectively lead hiring trends by 9 months. And that makes sense because when financial conditions are very loose, it means the dollar is weak, equity multiples are high, credit spreads are very tight. Companies are in a good position to hire. They have easy access to credit markets. They have an ongoing economic activity, which is good. Give it a bit of time, and 9 months later, they'll probably pick up their pace of hiring. Now try and do the opposite. That's the orange line going down, and that's what happened in 2022. Financial conditions were tightened very aggressively. That's the Fed trying to slow down inflation. Dollar goes up, so earnings generally are hit by a stronger dollar. You have borrowing conditions becoming very prohibitive, very quick. So you have credit spreads rising, interest rates rising, the access to credit markets becoming much more complicated. So rolling over your leverage in your balance sheet becomes complex. You have basically financial conditions tightening. As you do that and the orange line goes down, with a lag 9 months later, your hiring activity on a trending basis will definitely slow down. If you tighten financial conditions, you are basically slowing down the economy. And as you slow down the economy, you slow down sales, earnings, activity. And at the beginning, you cut discretionary spending and discretionary activities. But later on, the longer you go, the longer these financial conditions remain tight, you will be forced at some point to cut labor. And that's what we are seeing as well nowadays happening in the tech market. Here, the red point is the moment when non-farm payrolls, according to this relation, are supposed to grow roughly at zero. Zero non-farm payroll creation means unemployment rate goes up because the labor force in the US keeps expanding a little bit every month. So you need to create some jobs to keep unemployment rate stable. I think unemployment rate will start going up again, starting in April, May this year. This will be consistent with not only an earnings recession, but also a labor market recession, which definitely marks the start of a broader recession. When it comes to the labor market, my last point here is that the housing market and the sum rule suggest again that the recession, including the labor market, is supposed to start in late Q2 this year. So May is my base case. The housing market is pivotal to business activity and the job market. And let's see why. The orange line here is the National Association of Home Builders Housing Index. It's basically an index that tracks the activity in the housing market. I inverted the index and I showed it on the left-hand side, which means when this index is going down very rapidly, it means the housing market is doing good. When this index abruptly goes up, like in 2007, 2008, it means the housing market is coming to a halt. On the right, you see unemployment rate lagged by 12 months. Now look at this very, very tight relationship. Effectively, a loosening of the housing market, and remember, when the line goes down, it means the housing market is doing better. So an improvement in the housing market leads to lower unemployment rate 12 months later. Vice versa, the housing market deteriorating leads to unemployment rate going up. Why does that happen? That's because the housing market, it's a very interest rate sensitive sector of the US economy. It's all based on mortgages after all. And including ancillary activities, the housing market represents around 18% of the US labor market. That's a very large number. That includes not only housing activities, but also ancillary activities related to housing, construction, furniture shops, mortgage brokers, etc., etc. Look at where we are today. The housing market in orange is literally coming to a halt, a sudden freeze. We are seeing signs of total unaffordability. So the marginal buyers cut out, mortgage rates are too high, prices are still on paper too high. Effectively, buyers are on strike and sellers are trying to hold off from selling. So far, they have kinda hold on, but they will not hold on for much longer. The reason is simple, and we're seeing it being evident in large institutional funds. For instance, it's the Blackstone Real Estate Investment Trust and KKR Real Estate Investment Fund. Those very large institutional investors have put up redemptions for their institutional investors to make sure money doesn't get withdrawn too much from their accounts. Why? Because if it would, they would be forced to sell inside their assets, their houses, their commercial real estate. And there wouldn't be a buyer at where prices are marked today. There wouldn't be. Now, the issue with this is at some point, some institutional seller will be forced to capitulate and to recognize losses and to flood the market with supply, and will be forced to hit a lower bid when it comes to new buyers, which means house prices will decline, in my expectations, by roughly 20 to 25% further to go. Seems like a huge number, but in reality, it just brings us back to pre-pandemic house prices. What's important from a recession perspective is that unemployment rate lags the development in the housing market. So as the housing market has quickly deteriorated, as you can see, over the last 9 to 12 months, US unemployment rate is set to follow in the cycle 12 months later. And that starts around, again, May to June this year. So if you put it all together, starting from credit creation, which has come to a halt, which signals earnings per share are going to start to turn negative in March, April this year. Broader economic activity, also pointing to a recession starting in around April, and same goes for new orders. The magnitude of this recession, as a reminder, is close to 2001, when earnings dropped around 40% from their peak. Looking at broader financial conditions, they have tightened so aggressively that the labor market is also supposed to turn for the negative in around May, which means unemployment rate goes up, and it's also confirmed by the housing market, which has come to a halt. When both unemployment rate goes up and earnings turn negative, you're looking literally at a recession. So my best case is a recession in the US starts in May. Now the big question is, how do you actually position for a recession? Now, at the Macro Compass, we do two things. We give you macro insights that are useful for an institutional investors to navigate markets. It's a data-driven approach, and it's basically a systematic macro approach, but it's also macro in plain English. I've managed a $20 billion portfolio. I've been there, and I know that being able to communicate and break down macro in simple terms, it's what matters the most. The second thing we do is we effectively give portfolio strategy, both actionable ETF portfolio and tactical trade ideas tailored for institutional investors. Also there is a quantitative risk management approach, sizing, everything is done in a very data-driven and quantitative way. One of the models we use to come up with asset allocation and trade ideas is the Macro Compass. That's what gives the name to the firm. The Macro Compass is a simple asset allocation model that looks at two main indicators. It looks at leading macro indicators here on the x-axis, and the monetary policy stance and the flow of financial money, so the so-called liquidity, basically, on the other axis. Now, effectively looking at these two axes, you can pinpoint where an economy sits and what will be the appropriate broad asset allocation to look at. Now, on top of this, we overlay, obviously, valuations, trending, momentum, and other, let's say, factors to come up with the final asset allocation. But this is where we start. And today, if you look at where US, Europe, and China are sitting here, you find that the US and Europe are sitting in quadrant 4. Quadrant 4 is a place where growth is decelerating. You are set to see growth decelerating. That's a recession starting in May, roughly, in the US, as we discussed. You're also looking at central banks, which are keeping the monetary policy stance very tight against equilibrium, pretty tight. And also you're looking at the flow of financial money, liquidity, bank reserves, declining very rapidly, both in the US and in Europe, and set to decline further as a function of quantitative tightening mostly. So you're sitting in the quadrant where for investors is really complicated because getting long beta exposure doesn't work in this environment. The economy is slowing down, central bankers are keeping conditions very tight at the same time. The market, though, is trying to reprice China. And China sits on the top right of this quadrant. Growth is set to accelerate in China. We have reopening, we have the credit impulse, which was okay-ish in China in 2022, couldn't feed into the economy as people were locked home. Now they have pent up real economy money, savings that they can spend in the economy. So China is sitting on the right end of the quadrant, but also the PBOC and the Chinese Communist Party are accommodating again. They're having a pro-business stance. They are trying to rescue now the real estate market. They are accommodating conditions to make China rebound strongly. As China sits here, the market's extrapolating that this Chinese temporary growth will actually end up boosting US and European growth sustainably as well. So they're trying to move the US and European dots towards the right end of this quadrant. And that's why value stocks, industrial commodities, emerging markets are doing well. That's why the Euro stocks is doing very well. We are re-rating European growth based on the Chinese spillovers to be sustainable and durable. This is a great environment to look for active macro allocation, because while it's true that the Chinese recovery is set to last, and we have been long China, we still are long China in our portfolios that you can check on the macro compass. While this is true, the spillover effects over US and Europe are only temporary in nature, in some cases have been overdone by markets. That gives great opportunities for people to position differently across geographies and across asset classes, because that is exactly the news for and the next 5 years. The news is that, I'm sorry, my dog has become a bit vocal, but I'm not sure, but maybe she calms down soon. The news for the next 5 years is that passive macro allocation is not the way to go. There are going to be so many cross currents, there are going to be so many different angles moving, both because of geopolitics, both because inflation has changed the perspective that policymakers will use when it comes to fiscal stimulus and monetary stimulus and fiscal tightening and monetary tightening. The pendulum, in other words, will switch much more rapidly between disinflation and inflation, growth and recessions. And as geopolitics plays an additional role into that, active macro allocation, data-driven quantitative macro allocation coming from experience and macro insights is the way to go. So I want to finish this presentation by saying that there is basically one way, if you like this presentation and you want to continue to follow the work on the macro compass, the easiest way really is to go on the macro compass website itself. You can see the link here. It's the macrocompass.com/subscribe, or you can just point at the QR code here. The real news is only for this conference and only for these listeners, there is a 20% off on annual subscriptions. The discount code to use is InvestPro. And most importantly, it's only for the first 10 subscribers, which will take advantage of this offer. Now, I'm going to leave here the QR code so you guys can point at it or visit the website, themacrocompass.com/subscribe, check our products. In the meantime, I will be open for questions on my presentation.
It looks like we have a few questions for you. First question, in the current bleak housing situation, are there good real estate stocks or funds to invest in now?
Well, this has been, this is a very interesting question because the housing market is still frozen effectively. If you look at housing sales, they are down 40% year on year. Buyers are still cut out of the market, but home builders, for example, have repriced up very aggressively over the last 3 months. And why is that? They have done so because they're extrapolating a durable Fed pivot. They're already looking forward to the point where mortgage rates will be 200 basis points lower, housing activity will restart, and as markets are forward-looking, they're anticipating this into the price already today. What do I think of that? I think that's wrong. I think the housing market has become, and home builders and housing stocks have become a bit too complacent to a Fed pivot. Because think it through with me. If you're Powell, there's one mistake that you can't do. Repeat the 70s. And in the 70s, what happened is the Fed relaxed too early against inflation. And so they loosened financial conditions, exactly like it happened over the last 3 months. That meant activity started again, borrowing started again, animal spirits started again. And as they did, a year later, inflation was even higher than the first high inflationary spur. Powell wants to avoid that, and to avoid that, he needs to make sure financial conditions don't loosen preemptively, which means this overexcitement about the Fed pivot, the preemptive Fed pivot, the positive Fed pivot, they're misplaced. From a risk management perspective, Powell needs to make sure animal spirits are calmed down, and that doesn't help the housing market and nevertheless helps home builders or stocks that have a beta to housing. So I would be very careful about taking exposure there at the time being.
Okay, great. How about, does a recession forecast drive dollar down, PM up?
Excellent question. So a recession is very interesting for the dollar because there are two different drivers. The first is when US nominal growth is negative, basically on a trending basis, the dollar generally should weaken with it as a function of the bond market, coming in aggressively. You'll have the Fed capitulating. For your reference, in a recession, the Fed doesn't cut 100 or 200 basis points. In 2001, the Fed cut 475 basis points during a long-lasting recession. Now, when the Fed cuts so much, normally as yield differentials shrink between the US and other jurisdictions like Japan or Europe, the dollar generally weakens against gold, against the yen, against euro. There is a but, though. And again, if you look at the 2001 experience, you would ask yourself, how did the dollar do in 2001? And the dollar actually went nowhere in 2001. The reason why the dollar didn't depreciate is the fact that during a recession, you have deleveraging, you have defaults, you have companies going belly up. And as they go belly up, they need to repay their debt. Repay their debt and deleveraging in a balance sheet recession basically push up the value of the collateral. The collateral in this case is the dollar. So it's basically you are trying to deleverage to close up your leverage positions. You're trying to get your hands on the dollar to make sure you can repay your liabilities. And as you go into that deleveraging process, the dollar gets a bid. So those are two conflicting forces working on the dollar way. I think so far we have seen the dollar depreciation that comes from wanting to price in a Fed pivot. Again, I would be careful extrapolating this is a one-way line down for the dollar and consider that the leveraging episode coming from labor market recession and earnings recession can temporarily also push up the dollar. So we should be careful about these two forces conflicting with each other when it comes to the dollar and the recession.
Okay, it looks like we have a follow-up to your first question. You stated that housing is going down. What about multifamily apartments? Will they go down as well, or will they be less directed by the downturn because people who can afford a house need a place to live?
Yeah, that's a good question. So if I would have to choose between the two, I would say multifamily maybe holds a little bit better. We are talking about, though, a relative value between two sectors of the same broad sector that will go down. So it's a bit like saying, I have one main driver that I expect to go down by 20 or 30%, and I'm looking at a subsector going down 15, another going down 30. So obviously there is a consideration to be made, but I wouldn't miss the big picture or miss the forest for the trees. And the forest is that the housing market is set to materially deteriorate going ahead. And yes, probably multi will do a little bit better.
Okay, great. It looks like we have time for one more question. Do you have an outlook on TLT and bond funds?
Yeah. So when it comes to bonds, again, all of these positions are reflected on the macro compass, ETF portfolios, and tactical trade ideas that you can find within our products. If you look at the bond market, I think investors have one luxury that they didn't have for maybe 10 years plus. They are paid to wait. This is incredible. We're in very uncertain macro environment, and generally owning cash or owning optionality is an expensive exercise. It's an option. You have to pay a price for that. Today, you get paid 4.5% risk-free interest rates in T-bills or in money market funds to allocate to short-term interest rate products with basically no risk, and you get paid for the optionality to wait. That's an excellent thing to have as an optionality. When it comes to the back end of the bond market, so let's say TLT, for instance, there the outlook was looking great in October last year. We have added some allocation to bonds. We still have to long bonds in the portfolio, but we're waiting for Powell to again be harsh, to make sure that animal spirits are calmed down, to try and hit the bond market a little bit more. Slowly but surely, we will be accumulating positions in TLT. Timing, of course, matters. The correlation between long bonds and other assets in your portfolio matter. The sizing matters. All of that, again, is taken into account in the macro compass portfolio construction and trade idea construction process. You can find it there in our products.
Great. Hey, everyone, that concludes our time for this session. Thank you all again for joining us, and thank you, Alfonso, for your presentation.
Thank you
Please
very
be
much.
sure to stay tuned as we have a lot more in store for you today.